Hello. The purpose of this video presentation is to give you a very simple guide to Forex investing. It's very much aimed at beginners. So what exactly is the Forex market? Well, first of all, it's the biggest financial market in the world with over $4 trillion traded daily. That's about 100 times the size of the US stock market. So it is absolutely massive. What it involves is basically buying one currency and selling another. So, for example, buying US dollars and selling Japanese yen. Currencies are always traded in pairs in this way. If you're a retail customer like you or I, and you want to set up an account, you would either do it via a Forex broker or direct with a dealer. The two are fairly synonymous, the main difference being that a dealer would actually take a position on the other side of your trade, whereas a broker would probably not hold a position himself. They would trade through another dealer. One of the major differences between the Forex market and other markets is that Forex is a 24-hour global market. You can trade at any time of the day or night, anywhere in the world, which is quite unlike the equity or the futures markets, for example. So why invest in the Forex market in the first place? Well, first of all, it's very cheap to trade. There are no commissions necessary. You don't have to pay commissions or fees to your broker or to your dealer. Some brokers do actually charge low commissions, but generally the way that the Forex brokers and the dealers make their money is on the bid and ask spread. So they will quote you a buy and a sell price, and they will make their money on the difference between the two. So you don't have to pay commissions or fees like you would in the futures market, for example. The startup requirements in terms of capital are very low. You can start trading with as little as maybe $250 or $300. Again, that's unlike many other markets. We wouldn't necessarily recommend that you start with such a small amount, but at least you can get into the market for a small amount like that. And there are some very tight bid-ask spreads. That's another good reason to invest. The difference between the buying price and the selling price in the Forex market is generally very, very small. So you're not losing money on that spread. As mentioned previously, it's accessible, so you can trade 24 hours a day online. So all you need is a computer and access to the internet to be able to do that. And it's a highly leveraged market. I'll speak more about that in a minute or so, but basically that allows you to control very large positions and to make big profits for a pretty small outlay. Of course, there is a downside to that, which again I will discuss. Just a couple more reasons to invest in the Forex market. The liquidity, you are always able to trade. There is no chance of anyone cornering the market in a particular currency, for example, or in a currency pair. Unlike with the equities market, like with, for example, what happened on the 6th of May 2010 with the flash crash, where people were unable to unwind their positions, in the Forex market that would almost never happen. You would always be able to trade. You would always be able to unwind a position if you needed to. There are plenty of free resources out there, different types of analytics and charts and graphical technical analysis packages. There are resources for paper trading, for setting up demo accounts. Typically when you set up a new account with a broker, you will have access to a demo or paper trading account, so you can try out positions first before you actually trade real money in the market. And it's very easy to get started, as mentioned earlier. You don't need a lot of capital to start, and all you need is a computer with an internet connection, and then you're good to go. So here's an example of a simple Forex trade. Say, for example, I wanted to buy 10,000 British pounds against the US dollar at an exchange rate of 1.5250. As I mentioned earlier, Forex trades are always done in currency pairs, so this is the pair of British pounds versus the US dollar. What I would do, I would buy 10,000 British pounds and I would be short then 15,250 US dollars. And the reason I would do that trade is that I'm hoping that the exchange rate between the British pound and the US dollar is going to go up. So a week later, I might sell those 10,000 British pounds at an exchange rate of 156.50. If my trade works out and the exchange rate does move up, that means my British pounds are now worth $15,650, so I've made a profit of $400, which is a good trade. So that's just a simple example. One word about leverage though. I mentioned earlier that a leverage allows you to trade large amounts with a small deposit. So to control, for example, $100,000, I would only need to pay a deposit of $1,000 if my broker was offering 100 to 1 leverage, which is fairly common. Some brokers offer 200 to 1 leverage on positions. But that enables me to make some fairly substantial profits from small investments. But there are advantages and disadvantages to this. The disadvantage being that if a position moves against me, my broker would make a margin call. Now what that means is he would call me for more money to cover for further losses. If I'm unable to meet that margin call, or if I'm unable to meet continued margin calls, then the broker would close my position. And then there's the possibility of me losing all of the initial deposit that I put down. So those are the advantages and the disadvantages to leverage. You can make a lot of money, but you can lose your entire deposit. Just a quick word about the different kind of orders that you can trade. There are market orders where you will buy or sell regardless of the price. You'll just enter the order into the market and your broker will trade for you. There are limit orders where you would only buy or sell if the price hits a certain level. There are stop loss orders which basically prevent you from losing too much money, because if the price moves against you a certain amount, then the stop loss would be triggered and you would trade out of your position. And there are things like good for the day orders or good till cancelled orders. That means that if you enter an order, it is only good for the day or good until you cancel it. So it will continue to be entered into the market every day until it's traded. Finally, how to actually get started? Well, first you choose a Forex broker. There are plenty of them to choose from. You deposit some money in an account. You need to be sure that you have a computer that's connected to the internet, and then you can start trading. Now, it's a good idea to do a little bit of paper trading first to make sure that you've got an idea of what you're doing and how the market works. But it's very, very simple to get started in the Forex market. So all that remains is for me to say to you, good luck, and I hope your trades work out well for you. Thanks for watching.